A bell rings on Wall Street and numbers move like weather. Hot, cold, crosswinds everywhere. For decades, corporations returned cash as dividends or buybacks to rivers feeding one ocean. Dividends arrived like paychecks, recurring, visible, taxable. Buybacks slipped underwater, quieter, flexible, arithmetic. In 2023, Washington touched the quieter river, adding a toll booth at the bend. To understand the toll, remember why the river swelled so fast after 1982 rules. SEC Rule 10 Billion 18 built a safe harbor, telling companies how to repurchase without manipulation accusations. Limits on daily volume, timing, and price created choreography for desks buying their own shares. Flexibility became policy by when excess cash appeared, pause when storms gathered on horizons suddenly. Another tide lifted repurchases after 2017. Tax reform encouraged cash returning from offshore. Tech and healthcare giants bought back stock like factories by steel routinely, at scale, unapologetically. Energy joined with windfall prices, banks after stress tests, consumer staples for steadier, reliable arithmetic everywhere. By 2022, S&P buybacks flirted with $1 trillion, a decade's creed written loudly. Critics saw financialization where supporters saw discipline. Both saw EPS bending when shares disappeared strategically. Executives often earned stock. Fewer shares meant targets easier, optics brighter, options deeper in money. Advocates answered, buybacks simply exchange cash for fractional ownership concentration, compounding remaining investors' claims. Idle cash earns little, reinvest or return. Markets judge both by price and patience. Into this argument stepped the Inflation Reduction Act with a quiet but symbolic excise, 1%. No on profit, but on the fair value of stock repurchased after December 31, 2022. A tax designed to nudge, not overturn, to signal without outlawing, to tilt the scales. 1% sounds small. Policymakers said, try paying it every time, then tell us small. Mechanically, the tax hits publicly traded U.S. corporations repurchasing their own stock from investors. Covered repurchases include redemptions and economically similar transactions. Even affiliates acting as purchasing hands. Crucially, the law nets repurchases against issuances. New shares offset buys during the taxable year. That recognizes dilution happens. A company shrinking share count less after raising capital pays less. There are exclusions that matter when council drafts programs, closing some doors and leaving others open. Repurchases under tax-free reorganizations can be excluded, with rules ensuring shareholders recognize no gain there. Total annual repurchases under $1 million are de minimis, ignored to spare small issuers complexity. ESOP contributions and many retirement plan issuances offset, while split-offs are carved with special treatment. RICs and REITs were excluded by statute, reflecting different payout regimes and investor expectations widely. SPA-C liquidations escaped the toll after Treasury guidance, given their return of capital character at termination. Dealers' ordinary course activities received accommodation carefully, recognizing liquidity provision isn't corporate payout engineering. But foreign parent structures face guardrails. Surrogate arrangements cannot dodge the toll through simple rerouting schemes. For CFOs, the calculus now adds a line. Buybacks cost 1% above market, execution. If your company buys $10 billion yearly, the excise adds $100 million immediately. Is that decisive? Sometimes not, sometimes yes. It depends on margins, leverage, valuations, alternatives available. Relative to WACC, 1% is small. Relative to competitive CAPEX, it can still redirect. Model the choice like engineers. Compare after-tax dividend plus investor incidence against net repurchase yield. Dividends trigger taxable income for many households. Buybacks tax investors only if they actually sell. Now buybacks pay 1% at the corporate level, a dead weight unless offset by issuances. Companies with heavy stock-based compensation already issue shares. Netting softens the excise significantly for them. Consider a simple example that keeps pencils honest without spreadsheets hiding hopes behind formatting conventions. Company Alpha repurchases $10 billion, issues $2 billion for options and acquisitions, net $8 billion repurchase. Excise equals $80 million. If its market cap is $300 billion, dilution reduction still compels. If CAPEX at 12 PR is scarce, the repurchase likely survives the toll easily. Now consider company Bravo, capital intensive, pipeline awaiting permits, projects clearing, threshold at 9%. 100 million buys a compressor station yielding reliability, regulatory goodwill, and future throughput margins. There, the 1% becomes a tiebreaker, sending cash to pipes rather than equity printing. Policy accomplished its nudge, fewer automatic buybacks, more projects with public benefits and actual productive capacity. Historically, dividends signaled stability, buybacks signaled flexibility. Both signaled confidence in cash generation mostly. 1% doesn't erase signals. It taxes the flexible signal to favor sticky promises slightly. Boards may tilt toward modest dividend raises, smoothing payouts across cycle noise and headline seasons carefully. They will still authorize repurchases opportunistically when multiples dive below intrinsic. Estimates delivered by analysts. Treasury's proposed regulations clarified valuation, timing, and the netting math that underwrites corporate calculators properly. Repurchase value is generally the cash paid. For non-cash, fair market value governs the measurement strictly. Netting is annual over issuance generates no credit carry forward. Under issuance cannot borrow from next year. Affiliates and funding structures are traced. Substance controls form, a familiar refrain in tax architecture. Shareholder outcomes remain a mosaic. Because taxes fall differently on different accounts and domiciles every time, retirement accounts defer dividend taxes. Taxable accounts prefer appreciation until sale, then rate arbitrage. Institutional investors weigh total payout, yield dividends plus net buybacks against dilution from compensation pools annually. For them, 1% is modest. Governance and price discipline still drive votes and engagement. Markets Front ran the law in late 2022, accelerating authorizations before the toll arrived silently. In 2023, aggregate buybacks dipped from peaks yet remained historically enormous by any comparative yardstick. Energy and tech still dominated. Banks returned after stress tests. Industrials mixed dividends with opportunistic authorizations. Price mattered more than habit. Programs flex to valuation rather than quarter-ending optics and reflexes. Critics wanted bolder moves, bans during layoffs, wage links, or quadrupling the tax toward deterrence. Supporters warned blunt tools misprice capital, harming pensions, index savers, and competitiveness for everyone today. CHIPS Act grants already barred subsidized funds from repurchases. Other credits considered parallel restrictions carefully. The compromise stayed symbolic, a price tag without handcuffs. A message without criminalizing corporate payout, discretion. History helps translate symbols. Washington has nudged payout, choices before with carrots disguised sometimes as formulas. Dividend taxation differences shaped corporate behavior for decades. Safe harbors encouraged buyback choreography afterward. A 1% excise enters this lineage as punctuation, not revolution, a over period. Komamate, they change emphasis. They make speakers think before rushing sentences. Investors can still read the payout language by scanning 3 gauges inside annual reports carefully. First, free cash flow after capex and working capital, the real fuel for anything besides storytelling and spin. Second, total payout yield, dividends plus net buybacks divided by market cap, adjusted for share issuance. Third, dilution rate from stock-based pay, netting tells truth. Gross buybacks can conceal treadmill mathematics. Boards need an updated toolbox where taxes are inputs rather than steering wheels for decision-making processes. Set hurdle rates above WACC, adjust for policy, and force projects to beat weighted alternatives. Treat buybacks as residual, not entitlement. Force repurchase price discipline through explicit valuation guardrails. Align compensation with return on invested capital, not EPS alone. That starves low-quality buyback temptation significantly. Employees, 2. Notice the choreography when dollars dance away while budgets freeze in conference rooms today. Smart firms pair buybacks with visible investment straining cohorts, plant upgrades, and safer shifts concurrently. Signals resonate deeper when capital returns occur alongside commitments to the productive core clearly. The 1% tax raises stakes for messaging. Bad optics now carry literal costs above metaphors. Political risk is a variable CFO spreadsheets can't ignore when authorizing multi-year payout programs anymore. The White House proposed raising the excise to 4%. Hearings trial balloon tougher restrictions too. Even without passage. Scenarios require modeling, shoulder hire, annual costs or pivot toward alternative payout channels. Flexibility favored buybacks. Policy friction redistributes flexibility toward dividends, capex, and debt reduction strategies. Zoom out, and the macro lens makes the symbol look larger than the raw percentage suggests. National savings, productivity, and equity allocation across households are all entangled with payout policy. Buybacks there. But widespread reliance creates fragility if innovation budgets thin. A small toll nudges balance, not repentance, pulling some dollars from optics toward operating moats. As the first year closed, lessons felt practical, not ideological, for finance teams everywhere. Book the excise accrual alongside authorization. Net issuances early. Avoid year-end surprises shaped by seasonality. Favor open, Market programs over accelerated structures when price discovery matters more than headline, speed, reliability. Keep independent valuation, notes when buying in M, and A contexts. Substance over form shields audits when questions appear. The next year will test whether nudges compound into habits or fade into service charges quickly. If dividends creep upward and capex beats guidance, nudges worked without breaking anything fragile broadly. If buybacks persist at peaks, case closed. 1% was price, not policy, nor persuasion convincingly. Either way, the scoreboard reads payout tilt, not prohibition, and markets still price nuance over slogans. Start at the CFO's dashboard, where policy turns into behavior when cash meets calendars. Keep the waterfall honest. Maintenance capex, working capital, resilient balance sheet, then distributions. Lift hurdle rates a notch above WACC to reflect friction, headlines, and uncertainty. Re-rank projects and payouts against that bar before authorizations leave the boardroom. Netting is not a footnote, it is the truth behind glossy authorization slides. Estimate annual issuance from options, RSUs, ESPPs, and M&A. Treat dilution like a treadmill. Plan buybacks on a net basis. The excise taxes net shrinkage, not gross optics. Publish the math so investors see real per-share ownership change, not cosmetic EPS. Choose the right instrument for the job, not the headline for the quarter. Open market programs maximize price discipline. ASRs by speed while adding timing risk. Issuer tenders make sense when shares trade well below conservative intrinsic ranges. Dividends smooth trust. Repurchases signal conviction. Neither replaces moats, products, or people. Communicate like a capital allocator, not a stage manager chasing applause. Tie every return dollar to strategy, pipeline, productivity, and safety investments viewers can see. Announce guardrails. No buybacks above X times FCF or Y premium to value. Bundle authorizations with training cohorts, plant upgrades, and resilience budgets both, and beats either, or. Revisit capital structure while rates and policy reset the ground beneath you. Debt reduction can create equity value faster than shrinking share count at high coupons. Target credit, metrics that lower spreads and widen freedom to maneuver in shocks. Remember the trade-off, buybacks are discretionary. Coupons are not sleep matters in storms. For investors, build a payout checklist that reads substance, not slogans. Total payout, yield dividends plus net buybacks divided by market cap beats partial measures. Track dilution separately. Large, gross buybacks plus heavy issuance is treadmill finance. Ask whether ROIC beats WACC and capex beats depreciation. Otherwise, distributions become slow liquidation. Incentives shape behavior. Governance plumbing becomes capital allocation in disguise. EPS targets paired with at-the-money options invite buybacks at cycle tops. Shift pay toward ROIC, free cash flow, and multi-year holding requirements. Flex authorizations with valuation bands, not calendar habits or peer pressure. Translate the excise into relative costs so models compare apples, not headlines. A 1% toll is roughly 8 basis points annual drag if buybacks match EPS. Taxable holders still defer tax on buybacks until sale. Dividends are current income. Heavy issuers net out much of the excise. True shrinkers pay the toll. Plan for policy scenarios, even when bills stall in committee hearing rooms. If the excise rose to 4%, who pivots first and why? Asset light, high-margin firms may absorb cost. Capital-intensive names tilt to pipes and plants. Dividend clientele would grow. Dividend futures price stickiness, EX date volatility gains weight. Cross-border form won't save substance. ANTI surrogate rules trace back to the payer. Peers without excise may widen valuation gaps, but withholding and ESG narrow differences. Policy is a mosaic. Count all tiles before moving capital across oceans. Tax overlays, regulation, and index flows travel with you into new domiciles. Details are policy. Valuation, timing, and netting mechanics set the bill. Repurchase value equals cash paid. Non-cash uses fair market value at settlement. Netting is annual. No carry-forwards for over-issuance. No borrowing from next year. Exclusions de minimis total. ESOP issuance, split-offs. Behavior should adjust at the margin, not abandon a tool savers still expect. Repurchases will tilt toward valuation, sensitive execution, and modest dividend ratchets. Mature firms will pair buybacks with automation, grid hardening, and workforce investments. Early transparency earns lower policy risk. Opacity invites headlines and proposals. Operational lessons from year one were practical, not ideological, for finance teams. Book excise accruals alongside authorizations. Net issuances early to avoid surprises. Favor open market programs when price discovery matters more than speed. Keep independent valuation files. Substance over form survives audits and questions. Run scenarios like stress tests before headlines force improvisation. Base case, rates higher for longer, excise 1% buybacks persist, dividends inch up. Soft landing, rates drift down, buybacks surge on dips, capex ramps opportunistically. Hawk case, excise at 4% dividend, growth outpaces buybacks, net shrinkage slows. Monitor 3 live dials to separate talk from traction in filings. Capex to depreciation above 1 signals reinvestment. Below 1 signals harvesting. R&D intensity reveals whether moats widen or marketing carries the day. Net share count shows real shrinkage. Multi-year trends beat one-year fireworks. On fairness, avoid rewarding insiders while workers wait in the rain. Pair returns with visible training cohorts, safer shifts, and plant upgrades. Tether executive comp to our OIC and safety with holding periods across cycles. Publish pay equity and incident metrics alongside authorizations. Receipts earn trust. On retirees, remember they rely on both Rivers checks and appreciation. Nudges that preserve reinvestment while maintaining payout reliability serve them best. The excise tilts rather than bans. Households still own the outcome. Keep total payout promises steady. Let channels flex with value and policy. For policymakers, keep nudges smart and fractures rare with a short checklist. Define repurchase cleanly. Keep anti-abuse strong but not punitive. Preserve netting against issuance. Tax real shrinkage, not compensation offsets twice. Pair nudges with R&D and training credits. Publish dashboards with sector-level receipts. The deeper Lesson outlives any percentage printed in statute or speech. We thrive when risk is rewarded, failure repaired, and rules visible. Policy should nudge, not steer. Boards should explain, not perform. Investors should measure. A 1% toll is a comma, not a period allocation, and trust right the paragraph. If this story gave you a new way to see history, subscribe.